In February 2014, a preliminary study by an accounting professor and a student showed that stock trades by SEC staffers produce abnormal returns over a 2-year period. The mass media blindly ate this up after a Bloomberg article ran a story on it. One in particular bothered me because it claimed that the staff engaged in excessive trading when the facts in that same article just showed there were 4,000 trades in individual stock over a 2-year period made by 4,000 staffers. An average of 1 trade per staffer over 2 years excessive? I think not. Let's look at how the study was conducted. The authors made a FOIA request to get the data behind the trades of the staff over this 2-year period, but it did not have the identity of the traders included. This means that the authors couldn't tell if an individual trader made or lost money on a transaction or whether they were working in jobs that gave them advanced knowledge of enforcement actions. Those were pretty big limitations, but yet the professor was telling reporters, it does suggest it is likely or probable that something is going on. I think not. There are 2 major findings in the study. The second finding was that the SEC staff has a Form 144 informational advantage. As I illustrate on my March 3rd blog on the CorporateCouncil.net, this is simply ridiculous because the professor doesn't really understand that Form 144s come in after the Form 4s are filed. Thus, the information on these Form 144s are already publicly known, and there's no way that the staff could have some sort of advantage. It's the first finding that really is the one that's caught the most publicity. And here are 5 reasons why there might be alternative explanations for why the staff sells so many stocks during an investigation. The first reason is that they're forced to sell their stocks in the financial services sector when they join the staff. This is one reason why there might be so many sales. The second reason is that there's a need-to-know culture at the SEC. Even though anyone working there can have access to the database, which shows 4,000 open enforcement investigations at a time, a lot of those investigations never go anywhere. These are called matters under investigation, known as MUIs, and they're really just a fork placed in the road when a staffer comes across something suspicious. They just note it, and then there might be other little bits of information that then cause the staff to look further. But it's only 1 or 2 staffers that are actively pursuing a particular investigation at a time. Those are the only ones who would have advanced knowledge of something material coming down the pike. The third reason is that people at the SEC, particularly the enforcement staff, knows that they themselves are under surveillance by the Market Surveillance Unit and enforcement. Once you work at the SEC, you realize how easy it is to catch people that engage in illegal insider trading. You'd be an idiot to do it yourself. The fourth reason is that if the SEC staffers really wanted a profit, they wouldn't sell, they would buy or hold. This is because stock prices generally go up once settlements with the SEC are announced relating to an investigation, because that ends the uncertainty of the investigation, which the market detests. The fifth reason is something from Russ Ryan of King & Spalding, that SEC staffers on the whole should know the market better than the average investor. I'm not sure that's right, but that's probable. The bottom line is that the notion that there's more than a tiny fraction of the SEC staff that would risk their jobs and reputations to engage in a little bit of insider trading is absurd. The SEC staff generally comes in 2 types: those that hope to work there for a long time, and then those that hope to parlay that experience into a higher paying job in the private sector. They wouldn't risk that just to make a few bucks.